Welcome to StockTok's deep dive into American Electric Power. American Electric Power is one of the largest regulated electric utilities in the United States, delivering electricity to millions of customers across multiple states. At the time of recording, the stock is trading at 133.66, sitting near the top of its 52-week range of 97.46 to 137.74. The 50-day moving average stands at 130.62, comfortably above the 200-day moving average of 117.3, a structurally constructive technical setup. The RSI, or Relative Strength Index, reads 54.6, placing the stock in neutral territory with no extreme momentum in either direction. Let's work through the fundamentals, scene by scene, starting with a quick business overview. American Electric Power generates, transmits, and distributes electricity through a network of regulated subsidiaries, with rate recovery mechanisms providing a relatively predictable revenue base. The competitive moat here is structural, regulated monopoly status in its service territories creates extraordinarily high barriers to entry. The StockTok score for American Electric Power comes in at 22 out of 100, signaling caution across most dimensions. Valuation scores 0 out of 20, financial health 7 out of 20, profitability 8 out of 20, growth 5 out of 20, and smart money just 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? American Electric Power trades at trailing price-to-earnings ratio of 20.04 times, meaning investors are paying roughly $20 for every $1 of current earnings. The forward price-to-earnings, based on projected earnings, climbs to 21.08 times, which implies the market expects earnings to decline slightly in the near term. That is a notable red flag, in our view. The PEG ratio, which divides the price-to-earnings multiple by the earnings growth rate to assess whether growth justifies the premium, stands at 3.61. A reading above 2 is generally considered expensive. Above 3 signals a significant valuation stretch by most institutional frameworks. The EV to EBITDA multiple, a capital structure neutral measure comparing enterprise value to operating earnings before interest, taxes, depreciation, and amortization, sits at 13.29 times. For regulated utilities, which the sector has historically traded around 10 to 12 times on this metric, that reading leans toward the premium end. The Guru Focus Value, an independent intrinsic value estimate, is 104.37 at the time of recording, implying the stock trades at a premium of 28.06% above that fair value estimate. Wall Street analysts, at the time of recording, have a consensus mean target of 138, drawn from 19 analysts, with a high target of 153 and a low of 122. The street is modestly constructive. The next earnings report is due May 5th of next year, with the street expecting earnings per share of approximately 1.57, with estimates ranging from 1.44 to 1.67. A near-term catalyst worth watching. Market sentiment around American Electric Power, as of the creation of this video, leans neutral, with insufficient recent news flow to skew the signal in either direction. In our view, the valuation score of 0 out of 20 reflects a stock that is pricing in a great deal of optimism with limited margin of safety. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist that assesses profitability, leverage, and operating efficiency signals, comes in at 6 out of 9 for American Electric Power. That is a passing grade, indicating the business is generating positive signals on most operational dimensions. However, the Altman Z-score, a composite model designed to estimate the probability of financial distress or bankruptcy, reads just 1.00. A score below 1.8 typically places a company in the distress zone, and that is exactly where this reading lands. For a regulated utility with predictable cash flows, this score reflects the sector's structurally high leverage rather than imminent default risk, but it is nonetheless a number that warrants scrutiny. The cash-to-debt ratio is effectively 0.01, meaning for every $1 of debt, the company holds just 1 cent in cash. That is an extremely thin liquidity buffer. Interest coverage, which measures how many times operating income can cover interest expense, stands at 2.66 times. Most credit analysts prefer to see this figure above 3 times. Below 3 signals meaningful vulnerability to rising borrowing costs. Debt to equity stands at 1.59, confirming this is a heavily leveraged balance sheet. In our view, the financial health picture here is constrained, manageable within a regulated framework, but leaving very little room for error. Next up, profitability. Is this business actually making money efficiently? Beginning with return on invested capital, the return the company generates on every dollar of capital deployed across the entire business. American Electric Power reports 4.76%. For a capital-intensive regulated utility, the benchmark here is often compared against the weighted average cost of capital. A return on invested capital near 5% in an environment where borrowing costs have risen meaningfully suggests the company is barely covering its cost of capital, which raises questions about long-term value creation. The gross margin, the percentage of revenue remaining after direct costs, is a robust 61%, reflecting the pricing power embedded in regulated rate structures. Operating margin, which accounts for overhead and administrative costs, stands at 24.62%, respectable for the sector. Net margin, the bottom line after interest and taxes, comes in at 16.37%. However, the figure that demands the most attention is the free cash flow margin, which is negative 7.49%. Free cash flow is the cash a business generates after funding its capital expenditures, and a negative reading means the company is consuming more cash than it produces from operations, relying on debt and equity issuance to fund its capital program. In our view, the profitability picture is mixed. Strong reported margins, but the free cash flow deficit is a structural constraint that investors in this name need to price carefully. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, American Electric Power has delivered revenue growth of 3.7% on an annualized basis. Extending the window over the trailing 5 years, the annualized revenue growth rate rises modestly to 5.2%. For a regulated utility, these figures are broadly consistent with what the sector tends to produce: rate-based growth driven by infrastructure investment rather than volume expansion. The key growth mechanism for a company like American Electric Power is capital expenditure into regulated assets, which then earn a state or federally approved rate of return. Book value per share growth, which tracks the accumulation of equity on the balance sheet and is a proxy for long-term value building, has grown at 7.4% over the trailing 3 years, a figure that is actually more encouraging than the revenue line and suggests management is successfully growing the regulated asset base. The dividend yield at the time of recording stands at 2.81%, which provides income investors with a meaningful return component, though the negative free cash flow margin raises legitimate questions about dividend sustainability without continued access to capital markets. The growth score of 5 out of 20 reflects a business that is growing, but growing slowly, and funding that growth in a capital-intensive manner that compresses free cash flow. In our view, the setup warrants scrutiny for investors who require organic cash generation to underpin their thesis. Now let's talk smart money. What institutional capital is actually doing with this name? 9 top-tier guru investors currently hold a position in American Electric Power, according to available 13F filing data. 13F filings are mandatory quarterly disclosures from institutional managers overseeing $100 million or more in assets, giving us a window into how sophisticated money is positioned. Among the notable holders, David Katz of Matrix Asset Advisors carries the stock at 1.92% of his portfolio, though he has recently reduced that position by 3.05%, a marginal trim, but a directional signal worth noting. Carl Icahn's Icahn Capital Management holds the name at 1.65% of portfolio with no change reported, suggesting a steady but not expanding conviction. Dodge & Cox, a well-respected long-only value manager, holds the stock at 0.56% of portfolio and has similarly reduced by 3.26%, the second reduction among our top 3 holders. On the broader institutional flow picture, only 11.2% of 13F filers are net buyers of American Electric Power at the time of recording. A reading above 50% would indicate net institutional accumulation. 11.2% sits firmly in distribution territory. More institutions are trimming or exiting than adding. Insider ownership stands at a low 0.24%, meaning management has minimal skin in the game. Over the most recent 3-month period, insiders reported 0 purchases and 2 sales, a further signal that those with the most intimate knowledge of the business are reducing, not adding. The smart money score of 2 out of 20, in our view, reflects a picture where sophisticated capital is largely moving to the sidelines. And finally, the verdict. Let's bring it all together. On valuation, the data suggests American Electric Power is trading at a meaningful premium to its estimated intrinsic value, with a PEG ratio above 3 and a negative margin of safety of 28%. In our view, the price leaves little room for error. On financial strength, the Altman Z-score in distressed territory and an interest coverage ratio below 3 times flag a balance sheet that, while typical for the sector, carries real sensitivity to the cost of capital environment. On profitability, the margin stack looks reasonable on reported figures, but the negative free cash flow margin is a structural concern that we would want to see addressed before building conviction. On growth, mid-single-digit revenue expansion is consistent with regulated utility norms, but it is unlikely to re-rate the multiple meaningfully higher from current levels. On smart money, the combination of net institutional distribution, minimal insider ownership, and 2 insider sales with 0 buys over the past 3 months is not the positioning profile of a stock building toward a catalyst. The GF score of 79 out of 100 suggests the business itself is of reasonable quality. The concern here is the price being paid for that quality. In our view, the setup warrants caution at current levels. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on American Electric Power. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.